Good afternoon. If you can hear my voice, could you just type a yes in the window? Good afternoon. My name is Swati Taneja, and as a Training Production Director with Informa, I'm delighted to welcome all our attendees today on an informative webinar on the changing role of the CFO from Beancounter to a business strategist. Thank you all for joining us this afternoon. The webinar will be led by Paul Slack. I'm sure a few of us may know him already, may have attended his courses or may have read his bio. But just to give you a quick understanding of Paul, Paul is a chartered accountant who earns fast-track freelance business specialists organization, a Cape Town-based financial service consultancy specializing in business rescue across all sectors of the economy. His major focus is higher education and rescuing universities in administrative distress. This extends especially to budgeting and cost control. Before I begin with the webinar, I'd like to make you aware of certain housekeeping rules for the afternoon. Slides that you will be seeing for the next 45 minutes will be available on our slide share page, and the link will be emailed to you in the next couple of days. The recording of the webinar will be available to download, and the link for the same will also be emailed in the next couple of days. Please take the time to complete a post-webinar survey that will pop at the end of the webinar. You can always type your questions throughout the session, and a time will be allocated in the end for the speaker Paul to address your questions. Without further delay, I'd like to now hand over to your webinar leader for the afternoon, Paul, and I hope you enjoy the webinar.
Thank you, Swati. Good day to you all. As Swati mentioned, I'm a chartered accountant. I've been qualified for about 31 years now, and I've currently consulting across all sectors of the economy. One of the specializations is in business rescue, and one of the other things that we do is also the fast close month end, where we help businesses finish their financial statements and their management accounts within 3 days of month end. The title today is the traditional role of the CEO from Beancounter to business strategist. I don't mean the word Beancounter to be any way disparaging, but that's what many people see the financial function as. All we are the people that keep the score of the business decisions that get made by the people in the organization. Starting off with the first slide, let's have a look at what the traditional role of the CFO is. I'm sure I don't have to tell the accountants among us that we spend a lot of our time ensuring transactional completeness. When the auditors come in once a year to check up on what we've done, the one thing that they seem to be obsessed about is that the information is complete, that everything is in that should be in. And therein is one of the drawbacks, because more often than not we spend a lot of time waiting for the last invoice to come in, when in fact we could be closing the books off a lot quicker. We're also very good at ensuring regular reconciliation of the accounts in the general ledger. We spend a lot of time ensuring that the figures are in fact correct and analyzing the various ledger accounts. My experience in business rescue is, unfortunately, many CFOs have not spent their time in this area, and has precipitated part of the problems in the company. But be that as it may, that's one of the main roles of or traditional roles of the CFO. We also then spend an enormous amount of time, certainly in the bigger organizations, managing people. And people management takes up a disproportionate amount of time for the CFO. As we all know, numbers are easy, numbers balance, people not so much. Second thing that we spend a lot of time doing is monitoring and control over finance. We ensure proper authorization. We make sure there's money in the bank, and we check up that the supply chain processes are properly followed. Many of the frauds that we see happening around the world are in these areas where people are not properly conducting their supply chain management processes. We also spend an inordinate amount of time checking up on the other managers in the organization that they have followed the due processes, and a lot of our work is in the control environment, as I've said. Unfortunately, in this area, that makes us the villains. We're the people who more often than not have to say no. The easiest way to control a financial organization, any organization from a financial perspective, as I have found, is when you walk into an organization, you seize control of all the bank accounts, and then you just say no. I've done this in more than one organization before today, and you can turn the finances around within a year just by saying no, making sure that people spend money correctly. But that does take our eye off the ball, and we do spend a disproportionate amount of our time doing transactional work. Another area for us is ensuring clean audits. Anything other than a clean audit is too horrible to contemplate. Any CFO worth their salt would ensure that they have a clean audit. Anything worse, and they will throw themselves on their swords. The auditors issue management letters after the audit, and an enormous amount of time is spent in meetings with finance committees, audit committees, boards of organizations, defending what has happened in the organization and cleaning up what the auditors have listed in the management letter. We spend a large portion of the first 6 months of any year correcting the management letter points and anything that one might consider being prior year errors. For me, the next big one is we try to stay up to date with a myriad of changes in laws and regulations. I'm sure I don't have to tell the accountants among you what the kinds of issues are that I'm addressing here. Since 2008, we've had Sarbanes-Oxley, we've got International Financial Reporting, IFRS, and the regularity of changes to IFRS is just frightening. There's a new revenue statement coming in the very near future, and that's going to cause large-scale issues for all of the CFOs amongst us. In my country, I come from South Africa, as you can probably gauge from my accent, and we've just had a new Companies Act, and I'm sure that happens from time to time in many other countries. Acts change, the Income Tax Act changes on a regular basis. Every year at least there's changes to the tax legislation. New IFRS statements coming out. For parastatals, there are new Treasury regulations on an ongoing basis. And we need to stay up to date with all of this if we're not going to fall foul of the auditors and be accused of not being on top of our jobs. All of this takes time. Overtime for the CFO is not an exception, it is the norm. We spend all our time checking. It's all checking, checking, checking and doing, and not spending enough time staying up to date. Many of us also have families, and we find no time or not enough time, and life is all about balances, and unfortunately for the CFOs amongst us, life is somewhat unbalanced. We work overtime just because there are not enough hours in the day. It doesn't have to be like this. The current problems we're experiencing, the speed of change in laws and regulations. When I was at school, we were dealing then in the old days with generally accepted accounting practice. I used to have a book that I have to know. My daughter recently wrote her final accounting exams. She's got 3 books, each one of which was larger than the book that I used when I was a trainee accountant. Things are changing, and they change fast. There's also a new trend, I'm not sure how new it is, but a trend in the proliferation of data analysis tools. There are enough software vendors out there trying to sell us tools to analyze our data, to analyze more data, to give us increasing drill down, and we end up in a state of analysis paralysis. If we want more detail and more analysis, it usually means we have to capture a higher level of detail into our books. That takes time. Puts me back to slide 1 where we talked about transactional completeness of information. Much of this means more software, more money being laid out on software, and we often have to then, as a consequence of the new software, re-engineer our processes. I have seen many times where the CEO from his friends hears about new fads in software, and the CEO then wants to chase the latest fad to be in touch with what's happening with his friends in their companies. So in the past, along came Total Quality Management, TQM, the Balanced Scorecard, and every couple of years something new seems to come about, and there's new software and new analysis and new things for us to learn. When there are these kinds of changes, sometimes what happens, there's a restructure in the company. CEOs seem to think that the best way to sort out a problem is to reorganize. I make the point again, more measurements take you longer to assess, creates more room for error, and the month end takes longer. I'm sure I'm not telling most of you what you don't already know. We are constantly being asked to do more with less. We are asked to cut costs. We are asked to cut staff. But the outputs that are required from us and the level of detail and the information required for us is on the increase, not the decrease. And then I ask if the annual budget is actually not perhaps part of the problem. I think the word annual says it all. Why is it annual? Why not more frequent? Why aren't we doing this on an ongoing basis? For example, every month. Rolling budgets is the way to go. It seems pointless measuring yourself against something that was perhaps set 12 or 18 months ago. The thing is, as soon as you introduce a budget, it becomes the thing to beat. But that's not enough. You should not be trying to beat the budget. You should be trying to beat the competition. If you beat the budget, people think you're a success. But perhaps you could have done 4 times better than just beating the budget. But because that became the new target, that's what everybody measured you against. The world changes fast. Setting your targets based on something that you may have done 12 to 18 months ago, it's just not relevant anymore. The chairman of Handelsbank in Sweden, Dr. Jan Wallander, did away with doing annual budgets altogether. His comment was, the budget gives you the wrong target. As soon as you introduce a budget, the aim in the organization becomes to beat the budget. What I want from my staff is for them to beat the competition. And I couldn't think of a better way to put it. I wonder if preparing an annual budget really is worth it. 6 monthly revisits or quarterly revisits to the budget, it's just not good enough. We need to be doing a revision of the budget at least every month because the world is changing that fast. At Informa, we do run a course on, it's called Advanced Budgeting. I do the lecturing for that. And the one thing we just about don't do is budgeting. It's all about rolling forecasts and other new mechanisms in budgeting. It has been proven that the average CFO spends 66% of their time on transactional type work and only 11% of their time on decision support or strategic thinking within the organization. And we have to ask ourselves, for the salaries we earn and the skills that we've developed over the years, is this the right balance of work? Is there not something else we could be doing? I'm sure we've all heard the saying, the only constant is change. I've heard that more than once in my life, and I actually then went and had a look at it and said, who said this? Where did this come from? Where does this, the only constant is change, come from? And you won't believe it, but it came from Heraclitus some 2,500 years ago. They were complaining then about change happening too fast. Well, it hasn't slowed down, and it's getting worse and worse for us. So what do we need to do? As CFOs, we need to make sure that we respond more rapidly to requests from the CEO and management and the board and anybody else who needs the information from us. They want relevant information, and they want it now. I was dealing recently with a fast change month end in the real world where we actually were doing an implementation, and the CEO said to me, I only get my information 3 weeks after month end. We've just spent a fortune on a, I won't mention the brand name, but on a large, very expensive software system, and I'm still only getting my information 3 weeks after month end. I need information. It doesn't have to be 100% correct, but I need it now. I want earlier information, and it can be, and in her words, it could be anything up to 80% correct, which I think is a bit of a low ball. But she wanted it sooner, and she wanted it not necessarily 100% accurate. So the CFO needs to be involved with management, needs to be giving them information that equips them to make the decisions that they need to make in their own lives. The CFO needs to find time to allocate the valuable resources, in this case money, to the best investment opportunities. With all the time that we take spending time on transactional issues, we are not identifying the best investment opportunities for the business. And those opportunities could be anything from a new marketing campaign to running a new product line or to investing in a new factory or plant. We need to find the time to do this. We can't find that time. There are only 24 hours in the day. You can't make more time. The only way to do it is to ensure that we spend less time in the transactional environment and more time in the strategic environment. We need to get closer to our managers. Many accountants, it is said, are not the best communicators and they are not the most user-friendly people. I don't believe that. I believe that we can interact more with management. We need to understand what their problems are and we need to address those problems. Every CFO needs to stay relevant. Where are we going to find the time? We talk about ongoing CPD. In some countries, that's an absolute requirement. Some countries are even measuring that. I know I have to log mine every year. Continuing professional development. Where are we going to find the time if we're spending all of this time on transactional issues? We need to stay relevant. As we've said, the laws are changing, the regulations are changing, IFRS is changing on a daily basis. And more often than not, we are so busy with our noses in the books at the companies we work for that we have no time to do these things, and we rely on our auditors or our consultants at high cost to come and do these things for us. There's just one problem with that. The more we use other people, the more the company looks at us and wonders just how relevant we are. If we're not staying up to date with our continuing professional development, we are going to become irrelevant to the companies we work for, or organizations we work for. I'm not trying to create stress in anybody's life here, but these are the facts. With the pressure on us in terms of having to have such a shortage of time and work overtime and stay on top of our CPD, many accountants are suffering burnout. I saw a research study recently where in America more and more accountants are leaving the field of accounting and going to do less taxing jobs, if you'll excuse the pun, because of the pressure involved in their everyday life, and it was causing problems with their health and their family lives. What needs to happen? The next point is, in fact, written in the negative. Do not chase the latest fad in analysis software. More analysis requires more time. I think I've made that point already. If anything, analyze less. Declutter your life. Beware of IT vendors selling you complex solutions to simple problems or problems that you don't even realize that you have, perhaps don't even have. Moral of the story is to measure the right things. Do you know what the 5 or 6 main drivers are for your organization? I was talking to a group just this morning in Dubai, and interestingly enough, when I asked the managers there what the top 5 or 6 drivers were in their organization, they weren't able to answer it. And it's usually just 1 or 2 things, simple things. I worked in the fishing industry for a long time, and one of the only driver that we were ever worried about was the cost per kilogram of fish. Simple as that. And that was driven by something else called the tons per sea day. Every industry has its own drivers. I can't pretend to know them all for your industries. In higher education, it is the cost per student. But interestingly enough, many of our accountants and CFOs out there know an awful lot about the latest, finest detail of some information, and they don't understand which are the biggest and most important drivers in the organization. This is critical. CFOs need to understand why things are and why things are uppermost in the thoughts of the management reports. We produce management reports in some organizations. I think they get measured by the kilogram. The management reports are very thick, and if you were to sit in a management meeting and look at what people are talking about, Or rather, if you were to sit there in the management meetings and analyze what it is that they're not talking about, you'll realize probably that half the stuff in your management reports are superfluous, but they're there because somebody asked for somebody to include a particular report 10 years ago. That person has since left the company, doesn't require the information anymore, but nobody's ever bothered to go back and revisit what we report and why we report it. Measure the right things. What are the main drivers in your business, and make sure you measure those. Remember, what gets measured gets done. Conversely, what doesn't get measured doesn't get done. So in order to be more specific, the annual budget, I truly believe, stifles business. I'm urging you to consider rolling forecasts, monitor only the current relevant data, keep trying to beat the competition and not beat the budget. Monitor against strategy all the time. An annual budget with an annual strategy can't possibly be the right way to do business in this fast-changing world. You need to be monitoring your strategy all the time. Things change. What happens if your competitors come out with a new product? It's not going to help you measuring against the budget you did 12 months ago. Avoid doing your annual budget. Avoid doing your budget. I'm going to take out the word annual now because I don't think we should be doing those anymore. Avoid doing your budget purely at a line item level. Rather, budget at a cost driver level. What are the big things that are important? And I've talked about those already. So does it matter if someone wants to budget $1,000 for stationery? That's not important. What are the drivers of the business, and how are they being budgeted for? And we need to do rolling forecasts, as I say, on all of those. If you do budget according to cost line items, that's what people will concentrate on. They will try and beat those all the time. Remember, when you set targets, the aim becomes to beat the target, not to beat the competition. And you end up with something called the law of unintended consequences. One example that I picked up of the law of unintended consequences recently, if I can just digress for a second, was in Mexico City. The government was very worried about the pollution, so they decided that everybody should only drive their cars half the time. And the way they were going to do that was to ensure that people could only drive their cars on odd days if their number plates ended with an odd number. The unintended consequence of that was everybody bought a second car. But because they were buying a second car, they couldn't afford a good car. They bought something that was a greater polluter. And in fact, Mexico City ended up with a greater number of gas guzzlers on the road and more pollution than they started with. That's the law of unintended consequences. What you measure is what gets done. Okay, I'm afraid I ran ahead with my slides. If you revisit the drivers of your business regularly, that's what will get attention, and that's really where you need to focus all your attention. More tools for you to consider. Change your month-end process. If you're not closing your month-end within 3 days, ask yourself why. This is a bit of a passion of mine at the moment. It's something I'm lecturing in Dubai these next couple of days, and it's very easy to achieve. When I was in the fishing industry, we introduced a large, very expensive software system, and we were still producing our accounts 3 weeks after month end. I didn't understand why, so I took my team away for a weekend, and we analyzed all of our internal processes. Without spending a cent, we managed to reduce in the first month by revisiting the processes. We managed to reduce our month-end close time from 3 weeks to 5 days. In the second month, we got it down to 3 days. Recently, I did exactly this exercise with a government organization, a government entity. In the first month, they managed to bring their close down from 3 weeks to 3 days. I couldn't believe it myself, but had I not seen it with my own eyes, I wouldn't have believed it. I'm not claiming any credit for that. Obviously, the people on the ground have to do the work. But it is possible. You don't need any additional software. You don't have to spend any money. In fact, you will save money because people will be working less overtime. It is purely a mind shift in a way that gets people to think about closing the month end rather than waiting for information to flow through a system which probably isn't geared for that information anyway. Use the time that you save from your 3-day close Use that time to flatten the structure and eliminate any inefficiencies in cost. It gives you time to do some more analysis. Remember, I'm saying don't go analysis paralysis, but it gives you more time to analyze the things that are really important to the organization. It does help you ensure that the information you are producing is valid and timeous, and I emphasize at the end. It's very important. Simplify your life. It may sound counterintuitive, but rather decrease the amount of information you give out, decrease the number of measurements and financial reports that you're issuing on a regular basis. Simplify, I can't say that enough. We tend to overcomplicate, and we should be simplifying our accounts. Remember, I'm not a big fan of spending more money on software. The latest software probably does the opposite to your life. It probably complicates your life. Does all of this sound too good to be true? Sadly not. It's not all that difficult to achieve. It requires somebody to sit back with their feet on the desk and think this through and make sure that the management moves along with them. Remember, you've got to understand what management needs, and you've got to provide that. More often than not, management sees you as the stumbling block, not as the person that they will first go to when they have a problem. It's cheap, it's simple, it doesn't take additional software, it just takes a mind shift. If you don't have what the customer wants exactly when he wants it, preferably at the click of a button, you're going to be out of business. It should be that simple. Informa does offer courses on these kinds of solutions, and we've successfully implemented this in a number of organizations. I make the point also in government organizations, which is probably hard to believe, but we have done it. In recent months, we've taken a government department down to a 3-day close. That's probably the exception, but I'm claiming credit for it because we were involved in that. It can be done, it should be done, and the business will rely on the CFO who can achieve these kinds of things, who can give relevant information, who can give valid information, who can give timeless information. It's there, it can be done. You just need to get your head in the right space. I hope I haven't oversimplified that. I would just like to share something with you quickly. It's an article I was reading on the plane over here. It happens to come from the South African Chartered Accountancy magazine dated February 2015, so it's hot off the press. If you go onto the South African Chartered Accountant website, you might find this article. It's called Driving Strategy, CFOs Embrace Technology and Risk to Drive Strategy. The things they talk about, there are 4 main headings. I'm just going to talk you through them quickly. Simplify the month-end and year-end close. That should sound familiar. I think it's something I've just been talking about. Embrace digitization for growth and risk management. There are simple solutions one can implement using simple workflow technology where we can get the information fast enough and relevant information fast enough to the people who need it. It doesn't have to be done manually. It is scary the number of people who download out of their very expensive systems into Excel to produce their management accounts. Partner with the business, that's the next item. In other words, understand who the managers are, what they do, and be their partner. And then deal with people. Put people at the heart of your numbers. You need to have the right people in your organization. You need to have the right people in your department. And that, dear friends, is the message. We're just checking to see if there have been any questions coming through. If anybody has any questions, please feel free to send them through. We haven't seen anything coming through online at the moment. Right, that having been said, there weren't too many questions coming through. I think it was a subject topic that probably was more of a listening issue than anything that was going to raise too many questions. So we'd like to thank you for your attendance. We see the number of people did attend from all over the place. Thank you very much for that, and we're looking forward to inviting you to future Informa webinars on topics. We'd love to hear from you as to how this one went and whether there's any other information that you would like that for us to cover in a webinar in the future. Have a good day, the rest. Thank you.